Today, Schedule A is one of the most common attachments to an individual tax return. In fact, most people who own their own homes qualify to take advantage of this tremendous tax savings tool. First, let me define deduction. It's an amount that can be legitimately subtracted from adjusted gross income in order to lower taxable income. Deductions are related to spending and can be divided into two groups, standard and itemized. To begin with, let's discuss the standard deduction, which is a fixed amount that can be deducted from adjusted gross income when calculating taxable income and tax owed. It represents an amount for the average person which Congress estimates as tax-deductible spending without requiring the taxpayer to identify specific expenses. 2 out of 3 returns use the standard deduction. The other third uses itemized deductions, which we'll discuss in a moment. The standard deduction, like exemptions, is a fixed amount that the IRS adjusts yearly. Moreover, in recent times, it has increased each year, thereby reducing tax burdens. A chart in your book illustrates the standard deduction for most people. Most taxpayers choose the standard deduction because it's easier to use. Either they prefer not to track their expenses or they find that the standard deduction is greater than their itemized deductions, which results in a greater tax reduction. Many times people with simple and straightforward finances also use the standard deduction option. The standard deduction for dependents may be limited. This pertains to dependents who file their own tax returns and not the taxpayer who is claiming the dependent. So let's imagine that Tyler is claiming his 17-year-old daughter Susan on his tax return as a dependent. Susan has a part-time job for which federal income taxes were withheld, so she also files a tax return. Tyler, Susan's father, may claim the full standard deduction or choose to itemize. Susan's standard deduction, on the other hand, may be limited. The standard deduction for dependents consists of a minimum standard deduction or a variable component based on earned income. Generally, earned income comes from work that the taxpayer performed and does not include passive income, such as interest and dividends. So, imagine that Susan, Tyler's daughter and dependent, had earned income of $300. In this case, she would claim the minimum standard deduction because it's larger than the total of her earned income. If Susan's earned income was $2,000, then she can calculate her standard deduction using her earned income plus the variable component. There's a worksheet in your book that will walk you through this calculation. There are bonus standard deduction amounts for taxpayers who are blind or over 65 years old. The charts in your workbook provide the standard deduction in each of these scenarios. The law defines a person who is blind as someone who, even with glasses or contact lenses, has 2200 or worse vision in the better eye, or if his field of vision is limited to 20 degrees or less. To qualify for the additional standard deduction on a tax return, the taxpayer will need to attach a statement from his optometrist the first year. Less than 1% of the U.S. population fit this definition, so the use of this bonus deduction is rare. Additionally, not all taxpayers qualify for the standard deduction. Sometimes the standard deduction is zero. That's right. The standard deduction can be zero. Although rare, 2 examples can demonstrate when the standard deduction would be zero. For example, let's imagine that a taxpayer is married yet decides to file a separate return. If he itemizes, then his spouse must itemize also. If the spouse doesn't have anything to itemize, she will automatically have a zero standard deduction. The second example is if the taxpayer is a non-resident or dual status alien during the year. Then his standard deduction is limited. A dual status alien is a foreigner who lives in the U.S. for only part of the year. Obviously, these situations are rare, so essentially, in most cases, you will likely deal with the standard deduction issues. If higher than the standard deduction, a taxpayer may choose to use itemized deductions instead. However, you must remember that the total itemized deductions must exceed the standard deduction or the taxpayer will be penalized. You should use the deduction method that is most advantageous to your client, whether it be the standard deduction or itemized deductions. We use Schedule A to calculate itemized deductions, which include medical expenses, taxes paid, interest paid, gifts to charity, casualty and theft losses, and other miscellaneous expenses. In this session, we will discuss medical expenses and taxes paid. The next two sessions will focus on the remaining parts of Schedule A. The first consideration to look at is taxpayer's status. Married filing jointly or married filing separately. If married filing separately, then you need to know if either spouse takes a standard deduction or itemizes deductions. If the client is filing married filing separately, remember, if one spouse itemizes, then the other spouse must also itemize, even if his deductions are zero. Let your client know that if he chooses to itemize, then the spouse must itemize as well.